The Fibonacci sequence is the series of numbers. Fibonacci retracements are popular among technical traders. They are based on the key numbers identified by mathematician Leonardo Fibonacci in the 13th century. Fibonacci's sequence of numbers is not as important as the mathematical relationships expressed as ratios between the numbers in the series, such as 0, 1, 1, 2, 3, 5, 8, 13, 21, 34. The next number is found by adding up the two numbers before it, and so on. Fibonacci expansion levels are lines in technical analysis calculated as the percentage between high and low price, which can be drawn above the highest high or below the lowest low price level. Fibonacci levels are always projection levels. Fibonacci expansion levels or Fibonacci extension levels follow the same logic as Fibonacci retracements. The most common levels used for Fibonacci expansion levels are 161.8% and then 261.8%. Some traders use 123.6, 138.2, 150, 161.8, 200%, and 261.8%. The MetaTrader platform has fib extension and fib retracement indicators, and it draws automatic lines on charts after the user picks their high and low level. The most common levels used for Fibonacci retracements are 23.6%, 38.2%, and 61.8%. Do not forget to subscribe. Please take a minute and look at a whiteboard for a moment. Let's learn some more stuff.
Hello traders, this is Igor from FX Igor YouTube channel, and today we have interesting topic. Starting with 0 and 1, each new number in the sequence is a simple the sum of the two before it. You know what is that? It is Fibonacci numbers 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on and so on. Well, it's a number that's equal to approximately 1.618. It's a golden ratio. This number is now often known as a phi, and its press is writing use a symbol for the letter phi from the Greek alphabet. Phi isn't equal to precisely 1.608 since, like its famous cousin phi is an irrational number, which means that its decimal digits carry on forever without repeating a pattern. So, from the science, we know that the golden ratio describes predictable patterns on everything from atoms to huge stars in the sky. The ratio is derived from something called as a Fibonacci sequence, named after its Italian founder Leonardo Fibonacci. Nature uses this ratio used to maintain balance, and the financial markets seems to as well. So, we will talk about Fibonacci numbers and forex market. First, in this lesson or this topic in this video, we will talk about Fibonacci expansion. But let me first, at the beginning, just a little bit start from the beginning about Fibonacci retracement. Fibonacci retracement levers are horizontal lines that indicate where support and resistance are likely to occur. They're based on Fibonacci numbers. Each level is associated with a percentage, and that percentage is how much of prior move the price has retracted. So the Fibonacci retracement levels are, for example, you know that 23.6% or 38.2% or 61.8% and 78.6% and so on. While not official as a Fibonacci ratio, 50% is also used. So you know that numbers, Fibonacci retracement levels. Very often traders use that. And we know that Fibonacci retracement levels connect any 2 points a trader views as irrelevant, typically a high point and low point. So we know high and low are very, very important levels. You know, daily low, daily high, weekly low, weekly high, monthly low, and so on and so on. And the percentage levels provided are areas where the price could stall or reverse. So we as a traders, we want to find important levels where markets reacts, and we want that. And the most commonly used ratios, like I said, 23.6, 38.2, 50%, 61.8, and 78.6%. This is very important in trading. Of course, in this lesson, we will talk about something different, because except these Fibonacci retracement levels, we have Fibonacci extensions levels. Fibonacci extensions are tools that traders can use to establish profit targets or estimate how far a price may travel after retracement that pullback is finished. Extension levels are also possible areas where the price may reverse. So common Fibonacci extension levels are 61.8%, 100%, 161.8%, 200%, and 261.8%. And the Fibonacci extensions show how far the next price wave could move following a pullback. Of course, all these levels we use for our targets. Usually, Fibonacci extension levels we use for our targets when we try to define stop loss, target, entry point. Of course, I need to repeat, even for Fibonacci retracement, even for Fibonacci expansion levels, extension levels, retracement levels, signals, possible areas of importance, but should not be relied on exclusively on that, because you need several triggers. Except level, you need to have several triggers when you enter in some trade. Fibonacci levels are just one trigger. Just to repeat that again. What we want to add on this story is all the levels are going to come from this string of numbers. This excludes the first few numbers, so when the string is going, if the number is divided by the number that come next, you will end up with the level numbers. So it is important to know that Fibonacci number 50% is not official percentage, but we know that a lot of pivot points and a lot of important levels are rely on 50%, because traders know that between the low and high we have 50% level, and that level is very important very often in trading. So let me talk about a little bit what do the levels say. The Fibonacci retracement and expansion are able to use in order to find out levels of stop loss, how to set target prices, place entry orders, and so on. If a trader knows that the stock is moving up and after its move it ends with 61.8% retrace and then it begins to bounce again, because the bounce was considered to be at a level on the Fibonacci scale, and if the trend stays for a long time, then a trader may decide to buy. This means that a trader could create a stop loss with a, for example, 78.6% level or 100% where it's originally started. These levels can also be utilized with various types of technical analysis. For instance, they are seen in the 11th wave theory and Gartley patterns. After a price has moved down or up significantly, when a price starts to retrace its path, which it seems to always do, this analysis will find a trace and notice that it reverses to certain levels. These levels are often at a static price that will not change often, unlike a moving average. In order to easily and quickly identify price levels, a static nature will be needed. This allows investors and traders to react and anticipate when a level may be tested. The levels will often be an inflection point, which may indicate where a price action could be expected, where it be a break or rejection. Okay, this is just a theory. I know you want to hear something new, something practical. So let me see one simple strategy. Of course, all this strategy you can see on our website, but here in this YouTube video we will give some example for sell trade. So your strategy can be for sell trade. You pick, in the first step, you pick low and high on the chart. In step 2, if you see that the price on hourly close is below 61.8% Fibonacci retracement, then make sell or trade. In step 3, put the stop loss on high price. Step 4, now there is a Fibonacci expansion levels and you need to calculate Fibonacci expansion level. Set your target to be, for example, 161.8% expansion level, or 200% expansion level, or 268.1% expansion level. So you calculated a target. This is it. You have a stop loss, you have a target, you have an entry point, and you can trade. Of course, you need to watch market condition, fundamental analysis, to create some plan, some exit plan. If you want to exit earlier or not, you need to see future economic calendar events and so on and so on. It's not just as simple to trade, but when you have edge, when you have levels, it's a great deal. And on the end, I will try to repeat again one very important thing that my colleague just say in the beginning of this video, and that is the Fibonacci expansion levels are lines in technical analysis. They are calculated as a percentage between a high and low price, which can be drawn above the highest high or below lowest low price level. Fibonacci levels are always projection levels. Fibonacci expansion levels or Fibonacci extension levels follow the same logic as the Fibonacci retracements. The most common levels used for Fibonacci expansion levels are 1.618% and then 2.618%, and some trades use 123.6, 138.2, 150%, 161.8%, 200%, and 261.8%, so on. And MetaTrader platform has a Fib extension and Fib retracement standard indicator and draws automatic lines on the chart after the user picks high and low level. It's very simple. You pick high, you pick low, and then MetaTrader will draw Fibonacci levels. The most common level used for Fibonacci retracement are 23.6, 38.2%, and 61.8%. For expansion levels, you can pick any number, an important level that you think it is important, but always look and always try to see, is market really reacts either to Fibonacci retracement, either to Fibonacci expansion levels. We need to see reaction. In past performance, you need to see reaction on that level. If you see in the past some reaction, there is a high probability that in the future, on that price level, we will see some reaction, some price action, something. Very often we will see that price oscillated around that level, cannot easily break that level. All that are signs that that price level is some strong, important level. Just watch that and try to be profitable. I wish you good day and bye-bye.